It started with a text message, a photo, house keys dangling in front of a freshly painted front door, big smiles, maybe a little housewarming reel set to some upbeat acoustic track. You liked the post. Of course you did, because you're happy for them, genuinely. But then you put your phone down, opened your brokerage app, stared at your portfolio for a second, and felt something you couldn't quite name. It wasn't jealousy exactly. It wasn't regret. It was something quieter and more unsettling than either of those things. It was the feeling of being invisible, because your friend is going to get a dinner party, a housewarming, cards, wine, probably a nice cutting board from someone. People are going to walk through those rooms and say things like, "You've really done something here," and "I can't believe how much you've grown up." And you closed the app, went back to your life, and nobody said a single word. That's the part nobody talks about, the silence of doing the right thing. This video is for everyone sitting in that silence right now, watching people around them buy houses, feeling that low hum of doubt, wondering whether they made a mistake by choosing to invest instead. And here's the thing, most people don't know. In many American cities, the person who kept renting and investing actually ends up wealthier than the person who bought. Not slightly. Sometimes by 6 figures. I'll show you exactly how in a minute. But first you need to understand something that most first-time buyers never figure out until it's too late. The house your friend bought doesn't actually cost what's on the listing, not even close. The average first-time home buyer underestimates the true cost of ownership by almost 40%. 40%. Think about that for a second. Imagine buying a car and discovering later that you accidentally ignored almost half the bill. That's what's happening. And the most expensive part isn't what most people think. We'll get there. But understanding why that gap exists is the first thing you need to know before you can honestly evaluate whether your friend made a better financial move than you did. The purchase price is only the beginning of the story. What comes after is where the real financial picture gets complicated. Let's break it down properly. When your friend bought that house, the number they talked about was probably the price, maybe the mortgage payment, maybe even the down payment, because saving that kind of money in this economy is genuinely hard, and it deserved to be celebrated. But here's where the story changes, because what almost never comes up in those conversations is everything else. And everything else is enormous. Before your friend slept a single night in that house, closing costs took between 2 and 5% off the top. On a $400,000 home, that's up to $20,000 gone before a single picture goes on the wall. Then property tax starts. Every year, forever. Adjusted upward as the home appreciates. Then homeowner's insurance. Then PMI, if the down payment was under 20%. And for most first-time buyers it is, because saving a full 20% on a $400,000 home means having $80,000 in cash. And most people in their late 20s and early 30s simply don't have that. So they put down less, which means they pay more. And then there's maintenance. This is the number that shocks people most. Here's the part that surprised me when I first saw the data. Financial planners recommend budgeting 1 to 2% of your home's value every single year just for upkeep and repairs. On a $400,000 home, that's up to $8,000 a year before anything goes wrong. A new roof runs $15,000 to $25,000. An HVAC system is $5,000 to $10,000. And a plumbing issue you didn't see coming is whatever the plumber decides it is. These aren't hypotheticals. Every house eventually needs everything. So when you add it all together, the real monthly cost of home ownership is frequently 30 to 50% higher than the mortgage payment alone. Most people on the outside never see that. They see the keys, they see the housewarming, they don't see the spreadsheet. Now here's where it gets interesting, because while your friend was dealing with all of that, something else was happening quietly on the other side of this story. Most wealth is built in silence, and the silence of your investment account compounding in the background, that's exactly what we're about to look at. Let's run the actual numbers. Imagine two people in 2015, same income, same starting point, same city. One scrapes together $60,000 for a down payment on a $300,000 house. The other decides the numbers don't work in their city right now and invests that $60,000 in a low-cost index fund instead. Fast forward 10 years. The homeowner's house appreciated. In a strong market, it might be worth $450,000 to $500,000. On paper, that looks like a win. But the real cost of owning that home over 10 years, mortgage interest, property taxes, insurance, maintenance, repairs, is often well over $150,000 beyond the equity built. Now look at the investor. $60,000 in a diversified index fund in 2015. The S&P 500 averaged roughly 13% annually over the following decade. That $60,000 becomes approximately $209,000. No property tax, no roof, no surprise plumbing at 11 on a Tuesday night. Just quiet, invisible growth. And when researchers have actually run this full comparison, rent on one side, all ownership costs on the other, real investment returns throughout, the investor comes out ahead in a significant number of American cities. Not always. Not in every market. But more often than almost anyone expects. And almost nobody believes that until they see the numbers. But then something weird happens. You show people the math. You show them the comparison. And they still feel like the homeowner won. The reason comes down to something very human. Homeownership is visible. It feels like winning. The house is real. You can touch it. You can host Thanksgiving in it. You can paint the walls whatever color you want. Nobody asks how your index fund is doing at dinner. Nobody tours your brokerage account. Nobody hugs you because your portfolio just passed $200,000. But here's the tension nobody talks about. Those same people might spend 15 years trying to catch up to what that account quietly became. The social reward structure of our culture is built entirely around homeownership as the marker of adult success. And that structure has nothing to do with mathematics. That is pure psychology. And once you understand that, once you really internalize that the celebration you're watching is an emotional milestone dressed up as a financial one, the silence of your own path starts to feel very different. Nobody celebrates the boring decision, but that doesn't mean it's the wrong one. Here's what nobody tells you about choosing to invest instead of buying. It is lonely in a way that is genuinely hard to explain to people who haven't experienced it. The discipline required to stay the course on a long-term investment strategy while everyone around you is hitting what the world considers milestones. It asks something of you that no financial textbook ever quite captures. It asks you to be okay with being misunderstood. Your parents might worry. Your extended family might ask questions that feel more like pressure than curiosity. And the hardest part isn't the external noise. The hardest part is the internal doubt. Because doubt doesn't announce itself as doubt. It arrives as a very reasonable sounding question. What if the market crashes? What if rent keeps going up? What if I wake up at 55 and I'm the only person in my circle without a house? Those questions are not irrational. They deserve real answers. Markets do crash, rent does go up, and there are real scenarios where buying is absolutely the right financial decision. If you're in a city with strong long-term appreciation and you plan to stay for more than 7 years, Buying often makes excellent financial sense. If you have stability, roots you want to plant, the non-financial value of homeownership is real and shouldn't be dismissed just because it doesn't show up in a spreadsheet. This isn't a video that says never buy a house. This is a video that says don't buy a house because your friend bought a house and you felt something at the dinner party. Don't buy because the culture told you it was time. Buy when the numbers work in your specific city, with your specific income, with your specific timeline. And until then, keep your head down. Keep contributing. Keep letting the invisible machine of compound interest do the work that nobody at dinner will ever applaud. Because 15 years from now, the person who bought in 2024 because everyone else was buying, they'll have equity, yes. A home, yes. But also 15 years of property taxes, maintenance bills, and opportunity cost. And the person who kept renting and investing quietly and without any fanfare for those same 15 years, they're going to have something that looks an awful lot like freedom. Not the Instagram version, the real kind. The kind where your money has been working for you so long that your options have multiplied in ways that are genuinely hard to explain to someone who didn't take the same path. That's the ending nobody tells you about when they hand over the keys. That's the chapter that doesn't get a dinner party. The silence was never proof you were losing. You already know which story you're writing. Stay in it. Comment down your thoughts on this.